Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. We are from Group 19, consists of 8 members. Today, in this video, we will be presenting about our project for Growbiz Mu'alaf project for our client, which is Miss Aminah. So, we would like to introduce ourselves. My name is Muhammad Zakwan.
My name is Muhammad Danish. My name is Ni Adham.
My name is Khadijah. My name is Ismail. My name is Ardini Balkis. My name is Alia Hisham. And my name is Anis Nasri.
Without further ado, let's begin with our presentation. Thank you.
Hi, my name is Khadijah with Malaysia with metric number 2310326, and I will be presenting on the background of our client's business named Ariski. Ariski is a business founded by Miss Aminah, a Filipino revert who have lived in Malaysia for 15 years. The company specializes in authentic Filipino sausages, offering a range of products including classic sausage, jumbo sausage, cheese sausage, and classic beef, all imported from the Philippines. The sausages are available in both frozen raw and cooked varieties to cater to different customer preferences. Currently, Ariski operates online from Miss Aminah's home in Qatar, utilizing popular delivery platforms like Foodpanda and GrabFood. The business mainly serves Filipino expatriates in Malaysia who are craving authentic Filipino flavors, but it also aims to expand its customer base by attracting more local customers as it grows in popularity. Looking towards the future, Miss Aminah plans to expand the business by opening a physical store in Kuala Lumpur. This move will improve customer interaction and offer direct on-the-spot transaction. Ariski is also exploring potential collaboration with frozen food delivery services like Long To You, Kawan Food, and Didi Cold Chain Delivery to maintain the quality of the products and ensure timely delivery as the customer base expands. A critical aspect of this expansion is maintaining strong long-term relationship with suppliers in the Philippines to ensure a steady and reliable supply of high-quality sausages, which will be the key to the business's continued success. That's all from me. I will pass to the next presenter.
Assalamualaikum warahmatullahi wabarakatuh. I am Ismail binti Ismail with metric number 2313346. Now I will present to you the classification of cost. Basically, cost is classified into two types, which is the fixed cost and also the variable cost. So, what is variable cost and what is fixed cost? So, variable costs are costs that change as the amount of production or sales changes. For example, as the production increases, the total variable cost also increases. Meanwhile, fixed costs are the costs that doesn't change based on how much a business produces or sells. In the other word, the fixed costs are paid regardless of the business activity. As for this Ariski business, the variable cost consists of direct material, which is raw material used to make the product, such as classic sausage, jumbo sausage, classic beefies, and also cheese sausage. The second one is direct labor, which is the cost of wages of people who work to make a product. Based on the business policy, the wage rate is RM5 per hour. Both the direct materials and the direct labor costs are the cost that is directly attributable to the product. Then, variable cost also includes the selling and administrative cost, which is the shipping cost of the direct materials, since the direct materials used in the production is being imported from Philippines. And the last one for variable cost is manufacturing overhead, that consists of indirect materials like oils, vegetables, spices, sauce, and packaging. Next, we move to fixed costs, that is usually comprised of indirect costs like selling and administrative costs and manufacturing overhead costs. For selling and administrative costs, the fixed cost includes the insurance expense and advertising expense, which usually will be incurred by the end of the month. For manufacturing overhead, it includes the depreciation of the equipment, such as the cooking equipment and the freezer. Also, it includes the rent and utilities. That's all for the classification of costs. Thank you.
Assalamualaikum, I am Anis Nasri binti Arifin. So we move on to the next part, which is pricing approach. So we have decided to use cost plus pricing for the business over the first 5 years of production, in which it's calculated based on full cost. So we have categorized the cost into direct material, direct labor, manufacturing overhead, and also selling and administrative costs. So after we have calculated all the cost for each year is all the same except for fixed selling and administrative cost per unit. As in years 1 to 3, the cost would be 17 cents and it rising to 30 cents per unit in year 4 to 5. So by that, it reflects increasing administrative costs that possibly due to higher advertising costs that increase to upgrade promotion initiative expense. As I have mentioned before, we have adopted a cost plus pricing model where the selling price includes the total cost per unit plus a markup. So the first period of production, the markup percentage is 48.94%, but then it declined to 45.45% in the second period. So as a result, the selling price for year 1 to 5 would be the same, which is 8 ringgit. So the reason why we decided to use a consistent pricing is to ensure stability in the market while maintaining a healthy profit margin. So our pricing strategy effectively balance production cost, market condition, and also profitability. Next, I will explain about the cost volume profit analysis for our sausage production during the 2 periods. So the CVP analysis helps us understand the relationship between cost, volume, and profit, which is crucial for setting production targets and making strategic decisions. So after the calculation, it shows the contribution margin per unit for years 1 to 5 would be the same, which is 4.40 ringgit. So the contribution margin represents the amount available to cover fixed costs and generate profit after variable costs are subtracted. In the first period, the break-even quantity is 4455 units, and then the quantity break-even sales increase in the second period to 4728 units, which means we have to sell this amount to cover all fixed and variable costs. So at this point, an increase in fixed costs would result in higher break-even point in the second period. So in order to achieve our target profit, we have calculated the required sales volume and it shows 13750 units must be sold in order to reach targeted income, and that's for years 1 to 3. While for years 4 to 5, we must to sell 14375 units to make sure profitability. In this CVP graph, it shows in years 1 to 3, the break-even point occurs at lower sales volume compared to years 4 to 5. So the upward trends in years 4 to 5 reflect higher fixed costs and the need for increased sales to achieve profitability.
Assalamualaikum, my name is Ardini Barki, so I will continue the presentation with our riskiest 5-year financial performance as reflected in the budgeted statement of profit and loss. We will look at the trends in sales, gross margin, selling and admin expenses, and net income. So let's start with the table. Looking at the sales figures, we can see steady growth over the 5 years period, starting at 96,000 in year 1 and reaching 152,000 ringgit in year 5. The sales price throughout these 5 years are remained at RM8 ringgit. However, in year 3, sales went down a bit to RM38,000 ringgit, but they pick up again in year 4 and 5, which showing a strong recovery. Moving on to the cost of goods sold, COGS, we observe a similar pattern where COGS decreased slightly in year 3 due to the sales drop but increased in year 4 and 5 in line with higher sales. The gross margin, which calculated as sales minus COGS, shows significant improvement in year 4 and 5, reaching 65,740 ringgit and 75,140 ringgit respectively. This indicates better cost management and efficiency. Selling and admin expenses remain stable for the first 3 years but increased in year 4 and 5 to 11,500 ringgit and 12,500 ringgit. This reflects investment in scaling operations alongside sales growth. Finally, net income, which is the bottom line, increased from 33,600 ringgit in year 1 to 62,640 ringgit in year 5. This is nearly double, with year 4 and 5 being particularly strong due to improved margin and higher sales volumes. To make these trends clearer, let's look at this chart, which highlights the sales, gross margin, and net income over the 5 years period. We can see that sales, which is the blue line, follow a steady upward trend. At year 1, sales amounted to RM96,000 ringgit, except for the dip in year 3, which amounted to Rm 88,000 ringgit, and rise back in year 4 and 5. This might be due to increasing number of competition, or maybe due to ineffective marketing by the business, which could lead to lower sales. Next, the gross margin, which the orange lines shows this growth. It dips slightly in year 3 due to lower sales, but the sharp rise in year 4 and 5 which shows improved cost management and higher profitability per unit sold. Finally, the net income, which is the green line, reflects these trends, increasing significantly in year 4 and 5, reaching a peak of 62,640 ringgit in year 5, comparing to previous year, which year 3, which net income only amounted to Rm 28,960 ringgit. This growth highlights the company's success in controlling costs and scaling its operations efficiently.
Next, the budgeted statement of financial position for Al-Rizki summarizes the company's financial performance and position over 5 years operation. It highlights steady growth in asset and also equity while maintaining the manageable liabilities, reflecting prudent financial management. For the asset overview, the total asset increased from 44,855 ringgit 50 cent in year 1 and increased to 228,570 ringgit in year 5, driven by growth in cash and also inventory. By year 5, cash rose from 33,727 ringgit 50 cent to 221,119 ringgit, while inventory values also grew steadily. Non-current asset, mainly equipment, declined gradually due to depreciation from 1,000 in year 1 and increased to 5,000 in year 5. Next, equity grew significantly primarily through retained earnings from year 1, which is 33,760 ringgit to 217,040 ringgit in year 5. The capital base remains stable at 10,000 throughout the year. Last but not least, the liabilities. Current liabilities represented by account payable were well managed, ranging from 1,095 ringgit 50 cent in year 1 to 1,533 ringgit in year 5. In summary, Al-Rizki financial position reflects a strong growth and efficient management of the resources and also a stable foundation for future expansion.
Okay, so next I will continue to present about cash flow. So what is cash flow? Cash flow is basically the movement of money into and out of a business. There are two parts, which are cash inflow and cash outflow. Cash inflow is when the business receive money, either through making a sales or making a loans. Cash outflow is when the money go out of the business. Because in business, we incur a lot of expenses, like we need to pay back our debtor, we need to pay our worker salaries, we need to pay rent, and we also make a lot of investment like purchase of new asset that can help in the business operation. So why cash flow is important for business? By preparing a cash flow, business can track their day-to-day expenses and they can see whether for each year they have a sufficient balance amount of cash. If they have a great balance amount of cash, of course, business can expand their business by making a lot of new asset purchases, and not only that, they can also spend more on the marketing, because when we spend more on the marketing, maybe a lot of new interested buyer want to buy and try our product. Okay, so basically the table below is the cash flow that we prepared for 5-year period. In the year 0, there will be investing activities where the owner bring 10,000 ringgit as initial investment for business to buy asset like freezer and also cooking utilities. The business will commence the operation at year 1. Under operating cash flow, everyday business activities like sale, variable operating costs, overhead costs, and also selling and administrative expense, the total are being taken from the budgeted prepared earlier to find the cash flow before tax by deducting all operating expenses from total of sales. The deduction of depreciation for 5 years from total of budgeted sale are being done because it is a non-cash expenses. which does not involve any actual cash transaction. The tax effect represents cash outflow which need to be paid annually from the total of cash flow before tax with the rate of 15%. After deducting the tax effect, the cash flow after tax amount will be added with the depreciation amount to ensure accurate reflection of cash on hand. The payment of tax for each year will be paid at the same year to help manage cash flow more predictably and ensure that there are no lump sum payment to be made in the next year.
NPV is the difference between the present value of expected future cash inflows and the present value of expected future cash outflows. Referred to the NPV table, the year column represents the time in which the cash flows occur when year 0 is the initial investment and year 1 to year 5 is subsequent period. At the cash flows column, the negative cash flow is in year 0, negative 10,000, indicates an initial investment that was made to purchase asset for the business. And the positive cash flow in subsequent period shows the return from the investment amounting 182,398 ringgit and 10 cents over 5 years. Next, discount factor column, which shows the rate used to discount future cash flows to their present value, calculated as 1 plus 0.0672 power of time for year 0 until year 5. The last column in the discount cash flow where is show the present value of each year's cash flow. The discounted cash flow is calculated by dividing the cash flow by the discount factor. For example, the cash flow for year 2, 34,336 ringgit is discount to 27,068 ringgit when divided with the discount factor. At the bottom of the table, the total net present value is 145,446 ringgit, which is positive and indicates that the investment is expected to generate more cash than the cost of initial investment. This shows that the project is a success and worth pursuing. IRR is the discount rate at which the net present value of an investment becomes zero. It represents the expected annual rate of return on an investment. Refer to the calculation for internal rate of return, IRR. CF0 represents Y0 or initial investment amounted to an outflow of negative 10,000. From CF1 to CF5, it shows cash flows, cash inflows, and positive cash flow for the next 5 years. After year 0 or returns from the investment, the cost of capital is assumed to be 6.72%, and the IRR that the business will get is 300.43%, which is extremely attractive. The investment will be considered highly profitable since the IRR is higher than the interest rate. Therefore, in capital budgeting perspective, this investment should be accepted as it promises significant profitability. We believe that the IRR to be 300% seems to be abnormal. This is maybe because of our assumption that not realistic for the business. Something like this, the calculation IRR of 300,000 appears to be significantly higher than what is typically observed for most investment projects. This may suggest that some of the assumptions used in the financial projection are overly optimistic. Factors such as rapid revenue growth, significant cost reduction, and minimal competition may have been overestimated in the model.
Now we're moving on to the payback period. The payback period measures how long in years and or a month a company takes to recover the initial investment. The maximum acceptable payback period is determined by the management. We decided for our client business that the maximum acceptable payback period is 1 year since our client used her own capital to finance the business, and the finance amount is low, which can be recovered less than or in 1 year. To find the payback period, the initial investment needs to be divided with the annual cash flow at the time when the invested amount started to be recovered. In this case, year 2 is when the invested amount is started to recover. The amount will then be multiplied with 12 to convert it into months, we can observe that the payback period for 4.2 months is less than maximum acceptable payment period of 1 year. So we can conclude that the investment is financially attractive based on this metric, as the investment recovered its initial cost more quickly than the maximum acceptable time frame, which is generally favorable. To conclude our presentation, Ms. Amina wishes to expand her online business by opening a physical store, which is actually achievable based on our research and calculation, such as the NPV, IRR, and payback period. Even though there are some limitations that may be faced by Ms. Amina, since the economy can be quite unpredictable, and by the time she wants to open her physical store, our reports might not be suitable for the economy in the future. If that happens, we just hope that our report can be used as a reference in a upcoming plan. Thank you for watching. Assalamualaikum warahmatullahi wabarakatuh.